Standard costing, what it is and why it matters. Standard cost includes direct materials, direct labor, and factory overhead. Standard costing involves setting predetermined costs for materials, labor, and overhead, and then using these costs to produce a product or service. The goal is to produce a product or service at the lowest possible cost while meeting quality standards. Management can use it for decision-making processes such as pricing products or services, advertising strategies, and new product development. Standard costing for inventory is a system where companies assign predetermined costs to inventory items. This system tracks and manages inventory levels and cost and can be helpful in budgeting and decision-making processes. Standard costing can be a helpful tool for businesses of all sizes, but it is essential for larger companies with complex inventory systems. Several key factors influence standard costing for inventory, including the type of product or service being provided, current market conditions and industry standards, and the company's overall goals and objectives. At the core of standard costing is a robust data set on current and projected costs for each item in the inventory. This information is typically collected using software systems that support standard costing processes, such as ERP platforms or other specialized tools. Standard costing can effectively manage inventory levels and costs while providing valuable insights into how changes in costs or demand may impact business operations. However, it is essential to remember that standard costing alone is insufficient to ensure optimal cost management. Many other factors must be considered. For businesses looking to implement standard costing in their operations, working with experienced professionals who can help guide the process and ensure that all relevant considerations are considered is crucial. The ability of a firm to successfully control the cost, quality, and performance of its products and services is essential to that company's continued existence. Customers have an ongoing desire for products and services of a higher quality and performance at a higher level, yet at the same time, they want costs to become more affordable. A standard cost tool can help organizations better understand their costs and improve their financial performance. By setting and adhering to standard cost targets, businesses can more effectively control their spending and make better decisions about where to allocate their resources. The most common use of standard costing is in manufacturing. Many costs, such as materials, labor, and overhead, must be tracked in a manufacturing setting. Standard costing can help businesses keep tabs on these costs and stay within their budget. Another everyday use for standard costing is in service industries. For example, a hotel might use standard costing to track the cost of providing a room to a guest against the budgeted cost. This comparison can help the hotel identify areas where they are overspending or underspending and then take steps to correct those issues. Standard costing is a valuable tool for businesses of all types. It can help businesses track their actual costs against their budget and identify areas where they need to make changes. Using standard costing, businesses can ensure they stay within their budget and provide their customers with the best possible service or product. Businesses can use many different cost systems, and the one chosen can significantly impact decision-making and profitability. The cost system affects how costs are allocated to products and services, affecting the set prices. Each system has advantages and disadvantages, so selecting the one that best suits the company's needs is crucial. The system a business chooses will impact how it makes decisions and how profitable it is. Using standard cost information can also help businesses track their progress toward meeting their financial goals and identify areas where they may need to improve. Overall, the purpose of standard cost is to provide organizations with a valuable tool for managing their finances and improving their bottom line. How to create a standard cost. Let's say you are running a small manufacturing company that produces widgets. To determine the standard cost of producing one widget, you must consider the various costs involved in the production process. Here are some of the costs that you might need to consider. 1. Direct materials cost is the cost of the raw materials used to produce each widget. 2. Direct labor cost is the labor required to produce each widget. 3. Manufacturing overhead cost, the indirect costs associated with the production process, such as rent, utilities, and equipment maintenance. To calculate the standard cost of producing one widget, you will need to estimate the total cost of each component, and then divide that total by the number of widgets produced. For example, let's say that the direct materials cost for each widget is $1, the direct labor cost is $2, and the manufacturing overhead cost is 50 cents. If you plan to produce 1,000 widgets, your total cost for each component would be 1. Direct materials cost equals $1 x 1,000 widgets equals $1,000. 2. Direct labor cost equals $2 x 1,000 widgets equals $2,000. 3. Manufacturing overhead cost equals 50 cents x 1,000 widgets equals $500. Your total cost for producing 1,000 widgets would be Total cost equals $1,000 plus $2,000 plus $500 equals $3,500. To determine the standard cost per widget, you would divide the total cost by the number of widgets produced. Standard cost per widget equals $3,500 divided by 1,000 widgets equals $3.50. Therefore, the standard cost of producing one widget in this example would be $3.50. This can be useful for budgeting and cost control as it provides a baseline for measuring actual costs and identifying any areas where costs may be higher than expected. 3. Why do standard costs matter? Standard costing. Knowing what is expected and anticipated allows for better plans and performance. When your performance does not match your expectations, a variance arises between the standard and the actual performance. Companies operate similarly. They have an expectation or standard for production. For example, suppose a company is producing tables. In that case, it might establish standards for such components as the number of board feet of lumber expected to be used in building each table or the number of direct labor hours it is likely to use in the table's production. These standards can then be used to establish standard costs that can be used to create an assortment of different types of budgets. A standard cost is an expected cost that a company usually establishes at the beginning of a fiscal year for prices paid and amounts used. The standard cost is the expected amount paid for materials or labor rates. It is essential to establish standards for costs at the beginning of a period to prepare the budget, manage material, labor, and overhead costs, and create a reasonable sales price for a good. The standard quantity is the expected usage amount of materials or labor. A standard cost may be determined by history or industry norms. The company can then compare the standard cost against its actual results to measure its efficiency. Sometimes when comparing standard costs against actual results, there is a difference. Standard costs are typically established for reasonably attainable levels of efficiency. They serve as a target and help motivate standard performance. Assuming everything is perfect, an ideal standard level is set. Machines do not break down, employees show up on time, no defects, no scrap, and materials are ideal. Many departments help determine standard costs. In conjunction with production, purchasing, and sales, product design determines what the product will look like and what materials will be used. Production works with purchasing to determine what material will work best and cost efficient. Sales will also help decide the material in terms of customer demand. Production will work with personnel to determine labor costs for the product based on how long it will take to make the product, which departments will be involved, and what type and number of employees it will take. When a variance occurs in its standards, the company investigates to determine the causes to perform better in the future. For example, General Motors has standards for each item on a vehicle. It can determine a power antenna's cost and selling price by knowing its standard material cost and the labor cost of adding the antenna to the vehicle. General Motors can also add up all the standard times for all vehicles to determine if too much or too little labor was used in production. This difference can be attributed to many reasons. For example, the coffee company mentioned in the opening vignette may expect to pay 50 cents per ounce for coffee grounds. After the company purchased the coffee grounds, it discovered it paid 60 cents per ounce. This variance must be accounted for, and possible operational changes would occur. Cost accounting systems become more valuable to management when they include budgeted amounts to serve as a point of comparison with actual results. Standard cost example explained. For example, consider whether you would take a college course if the letter grades were as follows. An A is 99,100%, a B is 98, 99%, a C is 97, 98%, a D is 96, 97%, and below 96% is an F. These unreasonable and unrealistic standards would not motivate students to do well in the course. This standard level is not the best motivator because employees may see this level as unattainable. At the other end of the spectrum, there is little motivation to improve if the standards are too easy. Products may not be adequately built or constructed with inferior materials. For example, consider how you would handle the following grading scale for your course, and it is 50,100%. A B is 35, 50%, a C is 10, 35%, a D is 2, 10%, and below 2% is an F. Would you learn anything? Would you try very hard? The same considerations come into play for employees with too easy standards. Instead of these two extremes, a company would set an attainable standard, which is one that employees can reach with reasonable effort. The standards are not so high that employees will not try to reach them, and not so low that they do not give any incentive for employees to achieve profitability. It must consider the standard costs for materials, labor, and overhead to establish its possible standard costs for each product. The material standard cost consists of a standard price per material unit and a standard amount of material per unit. Imagine a coffee shop is trying to establish the standard materials cost for 1 cup of regular coffee. To keep the example simple, we are not incorporating the cost of water or the ceramic cup cost. 2 components of the cup of coffee will need to be considered. 1. Price per ounce of coffee grounds. 2. Amount of coffee grounds used per cup of coffee. To determine the standards for labor, the coffee shop would need to consider two additional components. 1. Labor rate per minute. 2. Amount of time to make 1 cup of regular coffee. To determine the standard for overhead, the coffee shop would first need to consider that it has two types of overhead, as shown in 1. Fixed overhead. 2. Variable overhead. Once a company determines a standard cost, it can evaluate any variances. A variance is a difference between the standard cost and actual performance. There are favorable and unfavorable variances. A favorable variance involves spending less or using less than the anticipated or estimated standard. An unfavorable variance involves spending more or using more than the anticipated or estimated standard. Before determining whether the variance is favorable or unfavorable, it is often helpful for the company to determine why it exists. 4. When did standard costing first get developed? The standard cost was first developed in the early 20th century to manage manufacturing costs. Frederick Winslow Taylor, the father of scientific management, popularized it. Standard cost is still used today to track and control costs in manufacturing and other industries. Though other cost management methods have challenged it, standard cost remains a popular choice for many organizations. Standard cost accounting was first developed in the early 20th century to manage and control costs in manufacturing businesses. Standard costing sets predetermined materials, labor, and overhead costs based on historical data and standard rates. This system allows businesses to track actual costs against standard costs and identify areas where costs are higher than expected. Standard cost accounting is still widely used today for cost management and control. Which companies first used standard costing? One of the first companies to use standard costing was Ford Motor Company. Standard costing is a system where companies set predetermined costs for each production unit. This helps businesses keep track of their spending and ensure that they are operating at a profit. Other early adopters of standard costing included General Motors and Chrysler. These companies saw the benefits of having a standard cost for each unit produced, which helped them keep their expenses in check and ensure they were making a profit. Today, standard costing is used by many different types of businesses worldwide. It is a helpful tool for managing finances and ensuring profitability. How to create standard costs. At the most fundamental level, you can generate a standard cost by averaging the most recent actual cost over the previous few months. This is the extent of the analysis used in many smaller businesses. However, there are some additional factors to take into account that could materially change the used standard cost. As follows. 1. Equipment age. A machine may produce a higher percentage of scrap than usual if it is near the end of its useful life. 2. Speeds of equipment setup. Equipment setup is expensive if it takes a long time and spreads over many units in a production run. A setup reduction plan could result in significantly reduced overhead expenses. 3. Labor productivity varies. Changes in the manufacturing process, such as adding new, automated machinery, affect how much labor is needed to produce a given good. 4. Shifts in the labor rate. Include it in the new standard if you know that employees will soon receive pay increases due to a planned raise or as required by a labor union contract. It might be necessary to align the new standard's effective date with the deadline for the cost increase to achieve this. 5. Learning curves. The production team becomes more effective as it produces an increasing volume of a product. Therefore, as production volumes increase, the standard labor cost should decrease. 6. Purchase conditions. By changing suppliers, modifying the terms of the contract, or purchasing in different quantities, the purchasing department may be able to. 5. How does standard costing help a company achieve its goals? 1. Standard costing is a tool that can be used to help decision makers understand the cost of producing a good or service. By setting standard costs for materials, labor, and overhead, businesses can track actual costs against these standards to see where they are incurring additional costs. This information can then decide how to improve efficiency and reduce expenses. 2. Additionally, standard costing can be used to create budget projections and compare actual results against budgeted amounts. This allows businesses to identify areas where they are overspending and adjust accordingly. Standard costing is a valuable tool that can help businesses save money and improve their bottom line. 3. Standard costing is essential to help a company achieve its financial goals. By setting and adhering to standard costs, a company can more accurately budget for its expenses and track its performance against these costs. This, in turn, can help the company make better decisions about where to allocate its resources and how to improve its efficiency. 4. Standard costing can help a company achieve its goals by providing a consistent and objective method for measuring costs. This can be helpful in both short-term decision-making and long-term strategic planning. Furthermore, standard costing can help identify areas where costs are higher than expected, allowing companies to take corrective action. 5. One of the advantages of standard costing is that it provides a consistent basis for comparison. This can help businesses identify areas where they are overspending or could be more efficient. Additionally, standard costing can help businesses budget more effectively and make better decisions about pricing their products and services. Overall, standard costing is a tool that can be used to improve business efficiency and effectiveness. While it has been around for a long time, it is still relevant today and can help businesses achieve their goals. Problems with standard costing. Despite the benefits of standard costing that were just mentioned for some application, there are many more instances where it is not a workable costing system. The following are some issues. Despite the benefits of standard costing that were just mentioned for some application, there are many more instances where it is not a workable costing system. The following are some issues. 1. Cost plus agreements. You must use actual costs per the contract terms if you have a cost plus contract with a customer, which requires the customer to pay you for your costs plus a profit. There is no room for standard costing. 2. Encourages inappropriate behavior. Numerous variances reported by a typical costing system will prompt management to make poor decisions to produce favorable variances. For instance, even though this increases the investment in inventory, they might purchase raw materials in greater quantities to improve the purchase price variance. Even though it would be preferable to produce in smaller quantities and accept lower labor efficiency in exchange, management may schedule longer production runs to reduce the labor efficiency variance. 3. A quick pace setting. A standard costing system assumes that costs won't change significantly in the near future, allowing you to rely on standards before updating the cost for several months or even a year. A standard cost, however, might become outdated in a matter of a month or two in a situation where product lifespans are short or where cost reduction is being achieved through continuous improvement. 4. Slow feedback. The accounting team completes a complex system of variance calculations at the end of each reporting period as part of a standard costing system. Reporting these variances is much too late to be useful if the production department is focused on providing immediate feedback on issues for prompt correction. 5. Unit level details. To provide information about discrepancies at a lower level, such as the specific work cell, batch, or unit. The variance calculations that are typically included with a standard costing report are aggregated for a company's entire production department. 6. Application of standard costing. Standard costing is a handy tool for many different types of businesses. When calculating the cost of ending inventory, it can be used in place or instead of actual cost, which means you may not even know you are using this technique. But there are some other potential applications where standard costing comes into play. 1. To assist in the creation of budgets and the assessment of the performance of management. 2. To perform the function of a control mechanism by highlighting actions that do not conform to the plan, drawing the decision maker's attention to circumstances that may spiral out of control and require corrective action. 3. To offer an estimate of the expenditures that will be incurred in the future that may be utilized for decision making. 4. To simplify the process of attributing costs to items for inventory assessment. 5. To offer folks an ambitious goal that will encourage them to attain it. Standardization brings several benefits. It is simpler to execute calculations and easier to implement basic performance controls, both providing opportunities for cost reductions. Primary reasons why a standard costing method might be utilized. In most cases, the standard costing approach is the one that is suggested for use by manufacturers. It compares the expenses that were incurred to the standard values to analyze variation so that performance may be monitored. It establishes predefined costs so that any variations between standard cost and actual cost show as deviations, which are documented so that they may be further investigated. Instead of utilizing historical information to calculate inventory value, it sets predetermined costs. Manufacturers use this strategy for two reasons. First, with a bill of materials and a routing, it is possible to build out standard costs rapidly. Second, it helps find chances to improve inventory by providing feedback via deviations. On the other hand, implementing this strategy can prove challenging and calls for a more significant investment in overhead. You must also identify how frequently standards should be created and guarantee continual analysis is performed to gain the much-needed variances. This generally entails daily tracking actual expenses and putting them in the system. Standard costing is typically used more frequently by firms who have stable, well-established processes and inventory levels as compared to manufacturers who do not have these characteristics. Despite this, it is a fantastic choice since it has the potential to deliver the highest expense management as well as the most significant degree of financial security. Because it affects your expenses, budgets, and profits, choosing a costing technique is one of the most significant decisions you must make if you are a manufacturer. Changing your costing techniques during the process will generate issues since it affects your financials, reporting, and taxes, if those aren't sufficient reasons to make an educated decision. consider that changing costing methods will likely cause complications. There are a variety of approaches available to pick from, and while it may appear as though the most advanced approach would be the best route to take, this is not always the case or the best response. There is no one best approach to costing that applies to all situations. The method that you use should be the one that is optimal for how your organization does business and the objectives that it has set for itself. However, the vast majority of producers use the standard costing technique. When using standard costing, it is essential to consider whether or not you will get a satisfactory return on the amount of time and resources you invest. This is somewhat actively searching for patterns, using the information to create changes, and assessing deviations or operational variations at the level of the manufacturing order or item. If not, your business might benefit more from using a different costing technique. Standard costing and inventory costing. Perpetual inventory systems make it easy to print reports showing your period end balances. You can then multiply this number by the standard cost of each item and generate an ending inventory valuation that hopefully closely reflects actual costs. However, if prices often change in reality, you'll need frequent updates for higher valued goods as well. While lower value items may only require one review every few months, or so before their values are updated with new market info gathered throughout those periods when sales were slower than expected due to either high demand, supply conditions, pricing signals being sent out from competitors' actions. The easy way to estimate your inventory's value is by printing a report showing the period end balance. If you are using a perpetual system, multiply this number times each item's standard cost and then add them all together, but don't forget about any changes in actual costs. It may be necessary for those to update values periodically as they change regularly or upon request from management if there has been a significant fluctuation between what was bought new versus used over time. Standard costing and overhead application. Standard costing is a predetermined overhead application rate where the production budget total cost equals the sum of all estimated variable and fixed expenses, calculated using actual results from the most recent period as a basis for the next period's pricing. It can be used within a job order costing system to accumulate costs. You can use a standard overhead application rate instead of waiting for hours or days to keep up with actual costs. This will aggregate the data and adjust this number every few months, so it's close enough to what happened in your business during that period without being too far off from reality. Adjusting the overhead application rate can help you keep your actual costs close to what they are. This is important because if this doesn't happen, it may take too long for all of these numbers and amounts that go into creating cost pools, making things very difficult to determine how much something should cost. Standard costing and price formulation. The company's custom products are a perfect example of how cost inflation can be industry specific. Custom product manufacturers have the challenge of accounting for each customer's requirement, which could include different unit quantities based on what they want to order or require from you in terms of changes at production levels when there is a higher volume. This calls for using longer runs with lower costs because those items will account solely for their inventory expenses rather than both materials' price points combined like before. Ensure everything stays accurate even though not all consumers purchase exactly alike amounts every time. Standard costing and budgeting. Budgeting is a process of planning and organizing your financial resources so that you can make informed decisions about where best to invest them. The budget always consists of standard costs since it would only be possible to include exactly how much something costs on any given day during finalization in this item-by-item breakdown. However, we use standards from earlier periods when creating our budgets for later comparison purposes, which means those numbers will continue appearing as part of reported earnings growth or decline over time. Standard costs are often used in budgeting to track and control costs. Standard costs can be used to track actual costs against budgeted costs and help identify areas where cost savings can be made. By comparing the two, organizations can identify areas where they may need to adjust. Standard costs can also be used to create budgets for future periods by using historical data on standard costs to estimate future costs. Standard costs are often used in budgeting to forecasting future costs. By setting standard costs for each item or service, businesses can more accurately predict their expenses and plan their budgets accordingly. This can help businesses avoid overspending or understanding financially and keep them on track. Additionally, standard costs can be used to evaluate actual costs against budgeted costs and help identify potential cost savings areas. Using standard costs in budgeting can help businesses control their finances and keep their spending on track. When an organization develops the standard costs per finished good sold, it can take the budgeted volume, multiply the two, and arrive at the total budgeted cost of goods sold. As the bomb is exploded out from finished goods to work in process to raw material, the dependent quantities for each of these manufacturing steps can also be estimated in terms of total cost and quantities required for production. Standard costs also typically include a scrap or waste factor at each production stage, so a determined percentage is added to the production quantities required, which helps procurement plan ahead and production not have any shortages during lineup time. What is the difference between a budget and a standard cost? The main difference between a standard and a budget is that a standard represents an expected cost, while a budget is a tool used to track actual costs. Standard costs are often used in pricing and decision making, while budgets are typically used for financial reporting and planning. Companies will use standard costs as a benchmark when setting prices or making decisions. Standard costs are based on historical data and expected levels of efficiency. They can be considered the ideal cost of producing something and provide a target for managers to strive for. On the other hand, budgets are actual costs that have been incurred. Companies use budgets to track spending and identify areas where costs are higher than expected. Budgets can be created for different periods and can track both revenue and expenses. While standard costs and budgets serve different purposes, they are essential in financial management. Understanding the difference between the two can help you make better decisions for your business. 7. What leads to an inaccurate standard costing? If standard costs are not accurate, it can lead to several problems. For instance, managers may make decisions based on inaccurate information, leading to suboptimal results. Additionally, incorrect standard costs can impact the financial statements and cause errors in inventory valuation. Lastly, tracking and controlling costs can be challenging if the standard costs are inaccurate. All of these problems can lead to suboptimal performance for the company. Standard costing is a technique used in managerial accounting to estimate the cost of manufacturing product or providing services. It involves setting standard costs for each component of the product or service and then tracking actual costs against these standards. Standard costing can help guide managers to control and reduce costs, but it can also lead to inaccurate cost estimates if the standard costs are not based on accurate data. The standard cost figure is the average cost of manufacturing one product unit. This figure includes all the direct and indirect costs associated with production, such as materials, labor, and overhead. To calculate the standard cost, all you need is the total number of units produced and the total cost of production. There are a few signs that suggest a standard cost is inaccurate. Using an inappropriate methodology leads to incorrect standard costing. This could indicate that the standard cost was calculated using an inappropriate methodology. One problem with standard costing is that it often relies on historical data, which may not be accurate or representative of current costs. For example, if the standard cost of a particular component has been based on the cost of the last batch of 10 purchased, but the price of that component has since gone up, the standard cost will be too low. This can lead to managers making decisions based on inaccurate cost information. Another problem with standard costing is that it can encourage managers to find ways to artificially lower costs rather than find ways to improve efficiency and reduce waste. For example, suppose managers are given bonuses for meeting or exceeding their cost targets. They may be tempted to cut corners and use lower quality materials or components to meet their targets. This can lead to substandard products or services, damaging the company's reputation. To avoid these problems, companies must choose a standard costing method appropriate for their product or services and ensure that the standard costs are based on accurate data. Otherwise, they may have inaccurate cost information, leading to poor decision making and substandard product or services. Fluctuating production volumes lead to incorrect standard costing. One of the signs that a standard cost may be incorrect is if it doesn't align with the company's current production levels. If production has increased, but the standard cost remains the same, it's likely that the standard cost is too low. Conversely, if production has decreased, but the standard cost remains the same, it's likely that the standard cost is too high. In either case, this can lead to inefficiencies and losses. Fluctuating production volumes can lead to incorrect standard costs. Standard costs are based on an average production volume. If actual production volumes fluctuate significantly from this average, the standard cost will no longer be accurate. This can cause business problems, as they may make decisions based on incorrect cost information. There are a few ways to avoid this problem. First, businesses can try to keep production volumes relatively stable. This may not always be possible, but it can help to minimize fluctuations. Second, businesses can use a weighted average standard cost, which considers recent production volumes and is more accurate. Finally, businesses can adjust their standard costs periodically to reflect changes in production volumes. Another sign that a standard cost may be incorrect is if it doesn't match the actual production costs. This can happen for various reasons, such as changes in raw materials prices or production methods. If the standard cost doesn't match the actual cost, it can lead to inefficiencies and losses. There are several possible causes of this problem. Inaccurate data leads to incorrect standard costing. If the data used to calculate standard costs is inaccurate, the resulting standard costs will also be inaccurate. This can happen if the prices of raw materials or other inputs fluctuate more than you expect or your production process is less efficient than you thought. If your standard cost calculation is based on low quality data, your standard costs will likely be incorrect. This can lead to several problems, including over or under invoicing, inaccurate inventory valuation, and poor decision making. It is essential to use high-quality data sources to ensure accurate standard costs. These sources should be updated regularly and carefully vetted to ensure accuracy. Accurate data will help you avoid costly mistakes and ensure your standard costs are as accurate as possible. Incorrect assumptions lead to incorrect standard costing. If your standard cost assumptions are incorrect, your standard costs will be inaccurate. This can lead to suboptimal decision making and ultimately lower profits. Ensure you thoroughly understand your cost drivers before setting standard costs. Otherwise, you risk making suboptimal decisions based on inaccurate information. One of the essential aspects of standard costing is ensuring that all assumptions are correct. Any inaccuracies will flow to the standard cost, leading to distorted financial reports. For example, if the standard cost of raw materials is underestimated, this will understate the cost of goods sold and overstate profits. Similarly, if the standard hours required to complete a task are overestimated, this will overstate the cost of labor and understate profits. Therefore, all assumptions used in standard costing must be reviewed regularly to ensure accuracy. Otherwise, incorrect standard costs could lead to serious decision-making errors. The resulting standard costs will be inaccurate if you make incorrect assumptions about your production process. For example, your standard costs will be too low if you assume that your production line can produce 100 widgets per hour, but it can only produce 80 widgets per hour. Outdated information leads to incorrect standard costing. One of the dangers of using outdated information is that it can lead to incorrect standard costs. The resulting standard costs would be inaccurate if the information is used to calculate standard costs. This can happen if prices have changed since you last updated your standard cost, or if your production process has changed and you haven't updated your standard costs accordingly. Standard costs are essential for pricing and budgeting purposes, so they must be as accurate as possible. If your standard costs are based on outdated information, they may no longer be accurate, leading to problems. To avoid this, keep your standard cost information up to date. This way, you can be confident that your numbers are accurate and won't run into any unwanted surprises later on. Who is responsible for calculating correct standard cost figures? Standard costing. The person responsible for calculating standard costs should understand accounting and finance. This is typically a management or cost accountant. They should also be able to use software to generate accurate reports. 8. The impact of bad standards on the financial statements. Income statement impact of bad standards. Failing to adjust the standard cost for production variances affects the income statement's cost of goods sold account. Companies can either overstate or understate the cost of goods sold. For example, when standard costs are higher than actual costs, the cost of goods is higher than expected, and profit is lower than expected. Actual costs lower than standard costs have the opposite effect, understating the cost of goods sold and reporting a higher profit. Balance sheet impact of bad standards. Ending inventory contains errors in the standard costing process. Like the cost of goods sold, ending inventory reported on the balance sheet can have overstatements or understatements. Standard costs lower than actual costs result in understated ending inventory. Standard costs higher than actual costs result in overstated ending inventory. If unexplained variances exist, the most accessible place for accountants to hide them is out of view in some balance sheet accounts. Over time, these add up. Then, the mess explodes all at once, and an entire quarter or year becomes unprofitable. Corrections impact of bad standards. Corrections are necessary to account for production variances. Accountants compare standard costs to actual costs and the end of a production period. The difference between the two needs adjusting to report ending inventory correctly. Accountants can expense slight production differences by posting them into the cost of goods sold. This is the most common adjustment to standard cost accounting processes. Summary standard costing and financial statements. The following list clarifies that standard costing is not always helpful and may result in incorrect management actions. However, as long as you are aware of these issues, adapting the approach can be profitable for some companies' operations. As standard costs do little to help identify where costs could be reduced or eliminated without affecting profitability, i.e., they also fail to provide an accurate enough estimate of how much inventory should exist based on specific rates set forth by managers. This will cause overages when picking items up from store shelves again. 9. How standard costs lead to poor decision making. Standard costs can lead to poor decision making for several reasons. Standard costs are widely used in decision making in many different industries and fields. These standard costs are calculated based on historical data, industry norms, or cost models. They provide a standard benchmark to compare actual results, allowing businesses to assess their performance relative to expectations. Also, standard costs are often used when pricing decisions or determining product profitability. For example, a manufacturer may use standard costs to determine how much a particular item should cost based on the inputs required for its production. Or a retailer might use standard costs to set prices for their products based on the average markup typically applied in their industry. Standard costs are essential in helping businesses make informed decisions that drive profitability and growth. Many businesses use standard costs to track expenses and decide where to allocate their resources. However, standard costs can often lead to poor decision making. Standard costs are often based on historical data. First, standard costs are often based on historical data, which may not represent current conditions. Second, standard costs can be inflexible, making it difficult to respond to market or business environment changes. Standard costs are essential to any business, as they help businesses track and analyze expenses. Typically, standard costs are based on historical data, that is, they reflect the past spending patterns of a company to estimate future costs. However, standard costs can also be based on other factors, such as external market conditions or changes in production processes. With standard costs thus playing such an essential role in guiding business decisions, companies must carefully consider their methods for determining these standard costs. In short, standard costs are a vital tool for managing company finances, but must always be used thoughtfully and with due consideration for their inherent limitations. Standard costs can lead to a focus on short-term results. Third, standard costs can focus on short-term results rather than long-term objectives. This is because standard costs are based on averages and do not consider the specific circumstances of each case. As a result, businesses may make decisions that are not in their best interests. A standard cost system is often used to assess and control costs in a business. This approach can be beneficial in certain situations, helping companies remain financially stable over the long term. However, standard costs can also have unintended consequences, focusing on short-term results at the expense of more strategic considerations. For example, standard costs are often tied to profit targets that must be met to receive bonuses or other types of compensation. As a result, managers may sometimes prioritize meeting these narrow goals over broader issues like innovation or customer service. Similarly, standard costs can incentivize responding quickly to fluctuations in the market rather than taking the time to strategize and plan for the future. Ultimately, standard costs should be carefully managed if businesses want to avoid these adverse effects and achieve their true potential. Standard costs can create a false sense of security. Additionally, standard costs can create a false sense of security, as businesses may believe they are saving money when they are not. Businesses need to be aware of the potential pitfalls of using standard costs. By understanding the limitations of this accounting method, businesses can make genuinely informed decisions about their finances. Standard costs can give managers a false sense of security. They often rely on these numbers to make decisions without understanding the underlying assumption and methodology. This can lead to decision making based on incorrect information, which can have serious consequences. Standard costs can also incentivize managers to manipulate data to meet targets. This can lead to unhealthy competition and encourage unethical behavior. Standard costs should be used wisely, and decision makers should be aware of their limitations. Otherwise, they can do more harm than good. Standard costs are often used to estimate expenses for a business or project since they provide a baseline against which actual costs can be compared. However, standard costs can also be misleading if they are not monitored and updated throughout the project. For example, standard costs may not consider fluctuations in labor prices or supplies, leading to underestimating actual expenses. Additionally, standard costs can give a false sense of security, making it seem like revenues will meet projections even if underlying economic conditions threaten performance. To avoid being misled by standard costs, businesses must pay careful attention to the factors that might impact their projects and evaluate their standard costs regularly to ensure that they remain accurate estimates. Standard costs can incentivize managers to manipulate financial data to meet budget targets. Standard costs can be an effective tool for incentivizing managers to meet budget targets. By setting standard costs in advance, businesses can establish clear and concrete benchmarks for success, which creates a powerful incentive for managers to reduce costs or drive higher revenue levels. However, standard costs also create the potential for managers to manipulate or inflate financial data to meet their targets. Some managers may withhold important information about operational problems, for example, or intentionally overstate revenues to appear more successful. Standard costs need to be carefully managed to avoid encouraging unethical behavior. By setting ambitious and attainable targets and providing ongoing support and feedback throughout the budgeting process, companies can help ensure that standard costs incentivize rather than harm productivity. As a result, standard cost systems can often distort management decision making and lead to suboptimal outcomes. 10. Standard costing frequently asked questions. Do most companies use standard costing because it is the best methodology, or because it is what everyone else is doing? Just because most companies use standard costing doesn't necessarily mean it is the best option. There are several potential implications of using a different costing methodology. For example, if you switch to a variable costing approach, you must ensure that your prices reflect the new cost structure. This could potentially lead to price increases for your product or services. Additionally, you would need to train your employees on the new costing methodology and ensure they are comfortable using it. Ultimately, whether or not to use standard costing should be based on what is best for your business. It is worth considering if you think a different approach would be more advantageous. However, you should carefully weigh the pros and cons before making any decisions. There is no easy answer to why we use standard costing. On the one hand, it could be argued that standard costing is the best methodology because it provides a consistent and objective way of measuring costs. On the other hand, it could be argued that we use standard costing because it is what everyone else is doing. Changing to a different costing methodology would be too disruptive. The truth is likely somewhere in between these two extremes. Standard costing has been around for a long time and has proven to be a reliable way of measuring costs. However, there may be situations where a different costing methodology would be more appropriate. For example, suppose you are manufacturing a unique product with very little competition. In that case, you might want to use a different costing methodology that considers your product's specific characteristics. Ultimately, the decision of whether to use standard costing or a different methodology will depend on the specific circumstances of each case. There is no right or wrong answer, but it is essential to consider all the implications before making a decision. What causes people to have such a poor grasp of conventional costing? Which errors do people typically make in standard costing? Most executives and business owners are familiar with standard costing from a definitional point of view regarding the manufacturing industry. The use, measurement, and benchmarking in financial statements are all sources of misunderstanding. For instance, what does the data indicate in words more applicable to your company? How do you connect the costing data from the financial reporting back onto the shop floor if there is profit erosion? Where do you focus your efforts to create progress? In addition, I have witnessed a great deal of confusion over the components that make up the standard pricing of a product. One of the most typical errors is including the overall price of the product, the cost of the sales team, or the cost of direct delivery to clients. While this data might be helpful for other types of analytics, it should not be used as a regular input for pricing. What role does standard costing application play in manufacturers' decision-making process? Standard costing allows producers to discover discrepancies between a product's anticipated and actual prices without allocating direct material, direct labor, and manufacturing overhead costs to that product, which may be an expensive and time-consuming process. These deviations from the requirements are assessed in the income statement, where management reviews and analyzes the material, labor, and overhead costs involved in the process. When it comes to the driving process and other shop floor changes, having a solid understanding of the underlying reasons for these discrepancies may go a long way. Consequently, this drove improvements in gross profit. In addition to this, standard pricing compiles data to make reporting easier. To accomplish this, you will need a system that can record various process information and then upload them to a financial reporting system. How can cost accountants provide better quality insights for decision making? As businesses face an increasingly dynamic and fast-paced environment, effective decision making has become essential for maintaining a competitive edge. One key role that is essential in this process is that of management accounting. Management accountants are responsible for providing the insights and data needed by business leaders to make important decisions about everything from expenditures and inventory levels to risk management. However, many management accountants struggle to provide accurate, high-quality insights regularly. Several strategies can help improve the quality of these insights and enable better decision-making. One helpful strategy is standard costing, which entails establishing costs for inputs such as labor, materials, and overhead. This gives managers a benchmark against which they can evaluate their expenses and assess areas where savings may be possible. Standard costing can also identify potential inefficiencies or issues within different processes that could lead to higher costs or increased waste. Other practical strategies for improving the quality of management accounting insights include using big data analytics tools, evaluating trends over time rather than at a single point in time, and taking an integrated approach that involves multiple departments within an organization. By incorporating these tools and practices into their workflows and analyses, management accountants can improve the quality of their work and its effects on an organization. How do you know which system is best for decision making and profitability analysis? Standard costing. There is no surefire answer to this question, as each business situation is unique. However, you can follow some general guidelines to help you choose the best system for your needs. First, you'll want to consider your business's specific goals and objectives. What do you hope to accomplish using a decision-making and profitability analysis system? Once you clearly understand your goals, you can evaluate different systems to see which will best help you achieve those objectives. It's also important to consider the data types used in the system. What information do you need to input to get the results you're looking for? Make sure the system you choose is compatible with readily available data. Finally, you'll want to consider the cost of the system. While you don't want to skimp on quality, you also don't want to overspend on a system that's more than you need. Carefully consider your budget and compare the features and costs of different systems before making your final decision. By following these guidelines, you can be sure to choose a decision-making and profitability analysis system that's right for your business. Are there any limitations to using standard costing data for developing key performance indicators? Yes, your data on standard costing may be used to produce key success indicators, which can help assess your performance in the past. These KPIs can be beneficial. However, utilizing this data to determine your key performance drivers is of utmost significance. Your KPIs will assist you in developing measurements of the day-to-day activities necessary to deliver the KPIs you have in mind. This is one of the most important advantages that may be gained by conducting root cause analysis of production variations efficiently and promptly. Why do so many organizations assume standard cost is their only option? Many organizations assume that standard cost is their only option due to its familiar nature, familiarity with the method, and convenience. Standard cost allows for easy comparison among companies and provides a way to track and control costs. Additionally, many managers are comfortable with this accounting system as it has been used for several decades. Although standard cost may be an appropriate choice for some organizations, it is important to consider other options, such as activity-based costing or process costing, that might provide more accurate results. What is the best way to learn more about standard costing and other alternatives? The best way to learn more about standard costing and other alternatives is to research online or read books on the subject. Starting here, https://benjamin.com/blog/category/stndrd+cost. Plenty of detailed resources are available that provide outlines and examples of different cost systems. Additionally, attending seminars or webinars is a great way to understand the various options available better. With enough dedication and effort, you can gain a comprehensive knowledge base in the cost accounting field. What are the main differences between standard cost in theory versus in practice? The main difference between standard cost in theory and practice is that theoretical models are used to simplify the complexities of real-life business environments. Standard cost theory typically assumes conditions such as no idle time, no machine breakdowns, a steady production rate, and 100% accurate information about costs. In contrast, standard cost accounting must account for the complexities of actual working environments where variances occur due to changes in sales volumes or demand. Additionally, it must also take into account factors such as machine breakdowns, inventory wastage, and labor disputes which are not accounted for in the theoretical model. Why do organizations need specialized costing software instead of out-of-the-box ERP standard cost solutions? Organizations need specialized costing software instead of out-of-the-box ERP standard cost solutions to ensure accuracy and precision when calculating costs associated with the production of product or services. Specialized costing software can be tailored to an organization's specific standard cost requirements, considering factors such as overhead costs, production levels, and labor rates. This allows organizations to have greater control over their cost calculations and ensures they do not deviate from standard accepted practices. Additionally, specialized costing software can allow for better integration with other financial systems, giving organizations a more comprehensive view of their accounts. How does relying on standard costing lead to suboptimal decision making? Relying on standard costing can lead to suboptimal decision making as it is often based on assumptions that may not accurately reflect the true cost of production. This could result in decisions based on inaccurate information, leading to potential overspending or loss of profitability. Additionally, standard costing can limit an organization's ability to adapt quickly to changing market conditions or customer needs, as changes must be accounted for manually if the company does not have a more dynamic and up-to-date cost system. As such, relying on standard costing could leave an organization at a disadvantage compared to companies better equipped to respond to changes in the marketplace. What is the relationships between robust processes, accurate data, and standard costing? Robust processes, accurate data, and standard costing have an interrelated relationship. Robust processes are necessary to ensure data accuracy when using standard costing. If a company's process is not structured properly, or if the data being used is inaccurate, then the accuracy of the resulting costs will be compromised. Accurate data, however, is necessary for standard costing to be effective. Without accurate data points and reliable methods of collecting that information, making sound decisions based on cost analysis becomes difficult. Overall, the successful implementation of standard costing requires robust processes and accurate data for organizations to make informed decisions about their production costs. Can an organization have more than one standard cost per product? Yes, an organization can use more than one standard cost for a single product. This could include multiple allocations of overhead costs among different product lines or separate standard costs for materials and labor associated with a given product. However, it would be best if you typically had the right FP and a product costing software to do so. Many traditional ERPs only allows for one standard cost per product per period. Multiple standard costs can provide businesses with greater insight into the true cost structure of a product, as well as the potential to leverage cost savings between products. Additionally, multiple standard costs can also be used to identify materials or labor usage discrepancies and support decision-making during budgeting processes. How can you ensure you hire the right cost accounting talent to set standard costs or product costs for your organization? When hiring cost accounting talent to set standard costs, or production costs for an organization, it's important to ensure that the candidate has a strong background in accounting principles. Additionally, the ideal candidate should have experience with cost analysis and associated software, such as financial forecasting tools. It is also beneficial to look for candidates who know relevant regulations and can effectively communicate complex financial matters in layman's terms. Finally, assessing a candidate's past successes in reducing costs and streamlining processes can provide insight into their suitability for the role. What is the best course of action if a standard cost is determined to be inaccurate? If a standard cost is inaccurate, the best course of action is to identify the root cause of the inaccuracy and ensure it is corrected. This could involve updating key assumptions or data points used in the calculation or changing processes to ensure accurate data collection. Additionally, organizations should review their procedures for setting up and maintaining standard costs regularly to ensure that their cost structure remains up to date and reflects current market conditions. Finally, companies should consider implementing more dynamic cost systems that are better equipped to adapt to changes in production costs quickly and efficiently. Because standard costing is so challenging, it is valuable to ask an expert to help fix the problems. https dividedby calendly.com/benjamin11 divided by 30 minutes. How do standard costs differ from creating a budget? A budget estimates the amount of money spent over a predetermined period and is typically maintained with the help of accounting software. However, this does not constitute the same thing as standard costs. A budget might include standard costs, but it also might include other things that aren't directly related to the cost of producing your product. For example, a budget might include travel expenses. For instance, if you intend to acquire a new piece of machinery to manufacture your product more effectively, you might include this expenditure in your annual budget. However, you might choose to ignore the price of this item when you are determining your standard costs. However, it may still indirectly affect your standard cost if it enables you to produce products in a shorter amount of time or with a smaller amount of waste. What is a concise definition of standard costing I can use to share with others? Standard costing is a calculated estimate of what costs should be under particular working conditions. It is constructed from an evaluation of the relative worth of the cost components. It links technical requirements, the quantification of materials, labor, and other costs to anticipated prices or wage rates for the period for which the standard cost is intended. The main goals of variance accounting are establishing control bases for stock valuation, work in progress valuation, and occasionally selling price fixing. How can standard costing improve inventory valuation and measurement? Inventory valuation is easier to understand with a standard cost system than an actual cost system. There is only one cost that typically doesn't change for a year. This is simpler and easier for business stakeholders to understand and use. Unit costs for batches of similar items can vary significantly under a system based on real costs. This variance might occur, for instance, if a manufacturing batch experiences a machine malfunction that drives up labor and overhead costs. Such special costs would not be accounted for in inventory under a standard costing system. Instead, these extra costs would be added to variance accounts after actual costs were compared to standard costs. Have there been new developments in how standard costing is applied? Yes, there have been new developments in how standard costing is applied. In particular, there has been a move away from traditional standard costing methods, which can be pretty rigid and inflexible, to newer, more flexible methods, such as activity-based costing. Activity-based costing considers the different activities that go into producing a product or service and assigns costs to those activities based on their consumption of resources. This makes it a much more accurate method for determining the actual cost of a product or service. As a result, standard costing is now being used more and more in businesses to understand their costs better. Is standard costing for determining profitability? There are a few different schools of thought regarding standard costing and profitability. Some people believe standard costing is an accurate way to determine profitability, while others believe it can lead to inaccurate results. Standard costing assigns costs to inventory based on predetermined rates. These rates are typically based on historical data and do not always reflect current market conditions. This can lead to inaccuracies in the calculation of profit margins. In addition, standard costing does not always consider all the costs associated with producing a product or service. For example, it may not include overhead costs such as rent or utilities. This can also lead to inaccuracies in the calculation of profitability. Despite these potential drawbacks, businesses still widely use standard costing to measure profitability. This is because it is relatively easy to calculate and can provide helpful information for decision-making purposes. Considering standard costing to measure profitability, it is essential to understand its potential limitations. You should also consult with an accountant or financial advisor to ensure that you use the most accurate methods possible. Is standard costing used only accountants? No, standard costing is not used only by accountants. It is a tool manager in different departments can use to help make decisions about pricing, product mix, and process improvement. While accountants may use standard costing to help prepare financial statements, managers can use it to make decisions that will improve the financial performance of their department or company. Standard costing can evaluate pricing strategies, product mix decisions, and process improvement opportunities. It is a powerful tool that can help managers make informed decisions that will improve the financial performance of their department or company. Is standard cost only used for budgeting? No, the standard cost can be used for a variety of purposes. While it is commonly used in budgeting, it can also be used to evaluate actual costs against expected costs, assess employee performance, and more. Standard cost can be a valuable tool in managing and controlling business operations. Standard cost is a significant element of both budgeting and costing. It provides a benchmark against which actual results can be compared, helping to identify variances. Standard costs also play an essential role in decision-making, as they provide a basis for evaluating different options and their potential impact on the bottom line. In short, a standard cost is a valuable tool for both financial planning and operational decision-making. Is standard costing used for pricing decisions? No, standard costing is not used for pricing decisions. A standard cost is an accounting tool that records and tracks the cost of producing a product or service. Pricing decisions are based on various factors, including market conditions, competitive landscape, and company objectives. While standard cost can help understand the costs associated with production, it is not typically used as the sole basis for setting prices. Instead, companies take a more holistic approach to pricing, considering all the above-mentioned factors to ensure they can achieve their desired profitability goals. Is standard cost used for make or buy decisions? Standard cost is often used as one of the key factors in make or buy decisions. Make or buy decisions involve trade-offs between the cost of making a product internally and the cost of purchasing it from an external supplier. Standard cost can help decision makers compare the relative cost of different options and choose the option that is most likely to minimize total costs. In some cases, standard cost may also be used to negotiate better terms with suppliers. Standard cost is not the only factor that should be considered in make or buy decisions. Other essential factors include quality, delivery, and capacity. Make or buy decisions are usually complex and require a careful analysis of all relevant factors before a decision can be made. Is standard cost used for production decisions? Standard cost is often used for production decisions, as it provides a consistent and objective way to compare the costs of different options. However, there are some situations where standard cost may not be the best option, such as when there is high demand for a product and companies need to quickly produce as much as possible. Companies may use actual costs instead of standard costs to make production decisions in these cases. There are pros and cons to using standard cost for production decisions. Some argue that standard cost is more accurate as it considers all the factors that go into producing a product. Others argue that actual cost is more accurate, including the real costs of materials and labor. Ultimately, it is up to each company to decide which method is best for their needs. Is standard cost used for management reporting? Yes, the standard cost is often used for management reporting. Standard cost can provide valuable information about a company's production efficiency and cost effectiveness. Management can use this information to make informed decisions about where to allocate resources and how to improve overall performance. In addition, because the standard cost is based on an organization's actual cost, it can be a valuable tool for benchmarking or comparing the performance of different businesses. For example, if two companies have similar products, but one has a higher standard cost, its production process may be less efficient or effective. This information can help management identify areas where improvements can be made. Finally, the standard cost can assess the financial impact of proposed changes to a company's production process. By calculating the expected change in costs for a given change, management can make more informed decisions about whether or not to implement the change. Standard cost can thus help ensure that a company makes the most efficient and effective use of its resources. Is standard costing for determining profitability? There are a few different schools of thought regarding standard costing and profitability. Some people believe standard costing is an accurate way to determine profitability, while others believe it can lead to inaccurate results. Standard costing assigns costs to inventory based on predetermined rates. These rates are typically based on historical data and do not always reflect current market conditions. This can lead to inaccuracies in the calculation of profit margins. In addition, standard costing does not always consider all the costs associated with producing a product or service. For example, it may not include overhead costs such as rent or utilities. This can also lead to inaccuracies in the calculation of profitability. Despite these potential drawbacks, businesses still widely use standard costing to measure profitability. This is because it is relatively easy to calculate and can provide helpful information for decision-making purposes. Considering standard costing to measure profitability, it is essential to understand its potential limitations. You should also consult an accountant or financial advisor to ensure you use the most accurate methods possible. Is standard costing used only by accountants? No, standard costing is not used only by accountants. It is a tool managers in different departments can use to help make decisions about pricing, product mix, and process improvement. While accountants may use standard costing to help prepare financial statements, managers can use it to make decisions that will improve the financial performance of their department or company. Standard costing can evaluate pricing strategies, product mix decisions, and process improvement opportunities. It is a powerful tool that can help managers make informed decisions that will improve the financial performance of their department or company. Is standard cost only used for budgeting? No, the standard cost can be used for a variety of purposes. While it is commonly used in budgeting, it can also be used to evaluate actual costs against expected costs, assess employee performance, and more. Standard cost can be a valuable tool in managing and controlling business operations. Standard cost is a significant element of both budgeting and costing. It provides a benchmark against which actual results can be compared, helping to identify variances. Standard costs also play an essential role in decision making, as they provide a basis for evaluating different options and their potential impact on the bottom line. In short, a standard cost is a valuable tool for both financial planning and operational decision making. Is standard cost used for pricing decisions? No, the standard cost is not used for pricing decisions. A standard cost is an accounting tool that records and tracks the cost of producing a product or service. Pricing decisions are based on various factors, including market conditions, competitive landscape, and company objectives. While standard cost can help understand the costs associated with production, it is not typically used as the sole basis for setting prices. Instead, companies take a more holistic approach to pricing, considering all the above-mentioned factors to ensure they can achieve their desired profitability goals. Is standard cost used for making or buying decisions? Standard cost is often used as one of the critical factors in making or buying decisions. Make or buy decisions involve trade-offs between the cost of making a product internally and purchasing it from an external supplier. Standard cost can help decision makers compare the relative costs of different options and choose the most likely to minimize total costs. Sometimes, the standard cost may also be used to negotiate better terms with suppliers. Standard cost is not the only factor that should be considered in the making or buying decisions. Other essential factors include quality, delivery, and capacity. Make or buy decisions are usually complex and require a careful analysis of all relevant factors before a decision can be made. Is standard costing used for production decisions? Standard cost is often used for production decisions, as it provides a consistent and objective way to compare the costs of different options. However, there are some situations where standard cost may not be the best option, such as when there is high demand for a product and companies need to quickly produce as much as possible. Companies may use actual cost instead of standard cost to make production decisions in these cases. There are pros and cons to using standard cost for production decisions. Some argue that standard cost is more accurate, as it considers all the factors that go into producing a product. Others argue that actual cost is more accurate, including the real costs of materials and labor. Ultimately, it is up to each company to decide which method is best for their needs. Is standard costing used for management reporting? Yes, the standard cost is often used for management reporting. Standard cost can provide valuable information about a company's production efficiency and cost effectiveness. Management can use this information to make informed decisions about where to allocate resources and how to improve overall performance. In addition, because the standard cost is based on an organization's actual cost, It can be a valuable tool for benchmarking or comparing the performance of different businesses. For example, if two companies have similar products, but one has a higher standard cost, its production process may be less efficient or effective. This information can help management identify areas where improvements can be made. Finally, the standard cost can assess the financial impact of proposed changes to a company's production process. By calculating the expected change in cost for a given change, management can make more informed decisions about whether or not to implement the change. Standard cost can thus help ensure that a company makes the most efficient and effective use of its resources.